Welcome to the DNR Capital Monthly Investment Review for April. My name is Mark Sedowy and with me is our Chief Investment Officer, Jamie Nicol. This month we discuss the range of factors that could destabilise the market after a strong run. We also provide our assessment on the current valuations and talk about the federal budget. Global markets produced another strong month. This was led by the European markets, following some favourable reactions to the initial rounds of the French presidential election. Despite some rising tensions around North Korea, it failed to make a dent on markets and the US market finished close to closing at all-time highs. The volatility index continues to trade close to 3-year lows. I'll now hand you over to Jamie to discuss the rest of the presentation.
Thanks, Mark. Markets have enjoyed a strong run in the last couple of months. We've seen geopolitical risk ease, and we've also seen concerns around inflation start to ease as well. So we're looking at a range of factors that could destabilise the market. The first thing on slide 4 is we think the inflation trade will re-emerge. If you look at these two charts, they both highlight the potential strength of the US economy. You've seen the Fed Philly Index, which is a real lead indicator for the level of activity in the market, is at very strong levels, and unemployment claims remain at 40-year lows. Now, the market has concerns around inflation have eased in recent months as the strong lead indicators such as these haven't been followed through with strong GDP growth, and also I think Trump's healthcare failure raised doubts regarding the rest of his plans, such as his tax and infrastructure spending. However, we think these lead indicators remain positive and growth is likely to re-emerge in the next quarter or two, and this will drive renewed interest in this inflation trade. The other question we're asking is just whether Trump can execute his agenda. The point we'd make is that with growth emerging in the US, it hardly needs more stimulus. In fact, while stimulus is probably good for the markets in the short term, in the longer term, it runs the risk of creating a bit of a boom-bust cycle. So the alternative is more of a grind forward and probably something that we would have a preference for. The other thing that we're looking at is just the domestic economy. We think it's a little mixed, but we're seeing some signs of strength, like we'll show you later on the business confidence is very strong, and we're seeing pickup in certain areas such as infrastructure, mining's picking up off flows, agriculture's pretty strong, tourism is still good. However, retailers in particular have had a very soft start to the year. I think the increase in living expenses associated with mortgage rates, utilities such as electricity, insurance costs, it's all causing a bit of a squeeze for the consumer, as well at the same time you're seeing a bit of a move away from shopping in store to online, and Amazon's announced that they're coming into Australia as well. The other thing we're watching is just this boom in apartments and housing in general. We certainly think that's got the potential to roll off over the next year. The government's doing all they can to try to put a bit of a squeeze on the housing market because they're under pressure from an affordability perspective. So there really is some mixed signs in the Australian economy, and we're really trying to tilt the portfolio to those areas that are best suited and are growing. Looking at valuations, as you can see here, the market's had a very strong run. We've seen it just come off its highs, but it still looks vulnerable to a sort of seasonal pullback that you often get around this period. When through May, June, we get a lot of downgrades as the market starts to set expectations for the end of the financial year, and also the market's sort of waiting on those earnings reports so they can understand where the value is in the market. We also think we look at the banks, and they didn't have the strongest reporting season. They also got a bit of a headwind from the budget, so all of those factors I think play into the fact that it wouldn't surprise us to see the market have a little bit of a pullback. When we're looking at valuations, the PE of the market remains towards the upper end of the range. However, when we look at the yield compared to alternatives, which is on slide 8, and the grossed up dividend yield still looks very, very good from an equities perspective. As a consequence, we're inclined to think that while the market might have a pullback, you want to be buying the dips, and there's still going to be a lot of interest in equities because of the differential between what you can get on an equity compared to a term deposit or investment in property or a bond. Now, as I mentioned before, the NAB Business Confidence Index is pretty good, and globally we're also seeing business confidence quite strong. You saw those lead indicators earlier. I think generally the economy looks pretty good, and I'm much more concerned about equities if we're coming into a much tighter period, much more recessionary environment. And while there are some headwinds, I don't think it looks too bad at present. Looking at the budget impact, there was it was a mixed budget really for the market. I think overall it was probably slightly negative just because there was a hit on the banks, who are a big part of the market. But in terms of the winners, definitely infrastructure companies, a lot of spend happening there. Lend-Lease for us should be well placed. I think small businesses should do well. Companies selling to small business because they get a discount on purchases up to $20,000. So if you're buying a small car or equipment, there's some tax deductions there. Very small positive for home builders, given that there's some benefits for first home buyers, but we think that's at the margin more than anything. We saw a removal of the Medicare benefits schedule freeze, which should be helpful for those companies which operate GP services. Wealth management gets a little bit of assistance with some incentives encouraging superannuation inflows, and certainly media stocks get a reduction in fees and a little less regulation, so we definitely think that's a positive. However, I think the main news flow out of the budget was the impact on banks, and slide 11. It has a hit of about 3 to 5% for the banks. The question is whether they will wear that, or whether shareholders wear that, or whether it gets passed on to customers and staff. We think it'll be a combination. We think maybe shareholders will wear a little bit, maybe 1%. We certainly think they'll pass it on via higher TD rates and also lower TD rates and higher mortgage costs and higher small business lending costs. Also, we're likely to see a bit of an acceleration in cost out, so staff might wear a bit as well. The probably one small positive for the banks, it probably takes the idea of a Royal Commission into the banks off the table. I think consumers generally, as I mentioned, were doing it pretty tough. The 0.5% increase in the Medicare levy does nothing to help them in that regard. So the continued pressure for the consumer, to the extent that the banks pass it on via mortgages, also adds a bit of pressure to the consumer. So we're just not that interested in companies with too much consumer exposure at present. The retailers, as I mentioned, they're continuing to see that consumer demand dampening, and so that's a key area that we see as very mixed at present. So looking at our overall positioning, we're underweight the major banks, with not holding any discretionary retailers. We've got Lend-Lease for the infrastructure spend. We think Macquarie Bank's probably impacted a little bit by the tax levy, but we think they'll enjoy some of the superannuation flows, and their pretty flexible business ability to grow around that particular levy. So we feel fine about Macquarie Bank.
We've purchased REA Group for the high conviction and socially responsible portfolios. They operate the online real estate website realestate.com.au. So over the past few months, we've seen a pullback in property listings volumes. So we think this is driven by expectation of stronger price appreciation, so resulting in less supply hitting the market. So we think as conditions start to tighten up, we should see a bit more of supply of property come into the market, and this will be very helpful for REA Group's revenue growth going forward. We also expect a tougher property market to increase the length per advertisement, so we think the revenue could get another uptick from that. We also think there's benefits as they improve their product mix, so as they get an increasing percentage of their premium products, and they're also investing in a lot of new products like Front Page and Audience Maximizer. And more importantly, the key thesis for the business is just the strong pricing power they exhibit. They're looking at increasing base prices by 10% per annum. So all else being equal, assuming flat volumes, the business should grow revenue 10%. And if you throw in some volume benefits, that's just an extra kick to the bottom line. So we also like their positions in Asia and the US. So we think there's a number of layers of growth. The company does trade at a high multiple, but it's a very high quality business and deserves to trade at a premium. And we think it can deliver strong earnings growth over the next few years as it continues to monetize its website and user base. So we funded that purchase by selling Fairfax. So our thesis in Fairfax played out as the market started to ascribe value to the domain business. So it was really underappreciated by the market, and then there was rumours of TPG coming in and having a look at buying the Fairfax group, and so our bid has eventuated, and at around above $1 that met our valuation target. So we sold the proceeds, and we still really like the real estate classifieds market. That's why we switched the proceeds into realestate.com.au, and we believe that's probably the best way to play that thematic going forward. So this concludes the D&A Capital Monthly Investment Review. Thank you for your time, and look forward to talking to you again next month.